Absolutely. And to your point, when we look up at the board over there, it's a mix of colors. So one thing that highlights is how these groups of stocks are actually sort of ungrouping. It's not as much the FAANG trade as we've seen before. Facebook trading very differently than Apple, which is trading very differently than Netflix. So there's a little bit of sentiment out there that maybe it's time to stop looking at these groups of tech stocks and look outside of them for some other value plays. And Microsoft certainly looks to be a favorite among investors right now.
This is even by country as well. So I had a bit of a charting moment here at the desk while you were at the Wall Street. I was looking at the difference between China Mobile, for instance, one of the largest Chinese tech stocks, minus 1.7% year to date. So slightly weaker in what has been a huge tech sell-off. Compare that to Baidu, down 20-odd%. But then also compare it to the gains in Microsoft, where you've had plus 25%, and Apple, that is around that 2% handle. So, you know, you've got very different moves even by country. And I wonder whether trade is one of the other big issues. If there is a resolution on trade, surely some of these technology stocks would show some improvement.
You would think that would be the case. Given how Apple has performed with this tariff threat, there's a lot of concern from analysts that people do not want to pay a higher price for iPhones, so that is certainly hurting the stock. The other point is that this software play is becoming important not just for the software companies, but for companies like Apple. Apple's really trying to brand itself as a services company, which it isn't quite yet, but you can see when companies like Microsoft, Salesforce reported earnings last night, massive beat. That stock is seen as a huge play right now. And so this idea that we need to move away maybe towards the software, also that could insulate you a bit from some of these trade tensions.
One thing that I was looking at as well overnight, there was an interesting article in the FT, and they were talking about the cash numbers for a lot of these tech companies, and that the cash reserves have actually dropped about 10% from where they were a year ago. Remember, we used to talk about trillions worth of reserves sitting offshore. They've gone down a little bit, still sitting on a lot of cash. But again, what's interesting is that so much of that cash has gone into share buybacks rather than capex spending. But then you look at the results of Salesforce yesterday, you look at Microsoft, the companies that are being rewarded now are not the companies who are doing the buybacks, but the ones who are actually investing for the future.
And we've seen that with Amazon already too, right? Amazon absolutely got just battered for so many years for not having a profit and for continuing to make those investments, and here we are, Amazon's performing strongly. The other point on this is that those hardware sales, there's just a general sense that it could be slowing down, so the investments are being made in the cloud, in services, and that's a reason to start making. I mean, a lot of companies don't have that infrastructure in place. It's important to use that cash towards that services investment.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.